What if I told you that the difference between retiring broke and retiring with over $1 million has absolutely nothing to do with how much you earn? It has nothing to do with luck, inheritance, or winning the lottery. And it definitely has nothing to do with trading stocks every single day or chasing the latest crypto craze. What if I told you that all it takes is investing just $300 per month consistently? Not for 1 year, not for 5 years, but long term. And by long term, I mean giving compound interest the time it needs to work its magic. In the next 30 minutes, I'm going to show you the complete wealth building system. This isn't theory, this isn't hype. This is the exact strategy that has created millions of millionaires around the world. We're going to cover why $300 per month is the magic number, the mathematical certainty of compound interest, how to choose the right investments, the automation strategy that removes all emotion, how to avoid the deadly mistakes that destroy wealth, real case studies of ordinary people who became millionaires, your exact action plan to start today. Welcome to Smart Money and Finance Guide. I'm Finn, and for the next 30 minutes, you're getting a complete masterclass in wealth building. Let's build your millionaire blueprint. Let me start by destroying a myth that keeps millions of people poor, the belief that you need a high income to become wealthy. The truth? I've met doctors earning $300,000 per year who are broke, and I've met teachers earning $50,000 per year who are millionaires. The difference isn't income. The difference is understanding this simple equation. Wealth equals income minus expenses multiplied by time multiplied by investment returns. Most people focus only on the first part, increasing income, but the wealthy understand that what you do with your money matters far more than how much you make. Here's why $300 per month is our target number. It's achievable for most people, yet powerful enough to create life-changing wealth. $300 per month equals $3,600 per year. Over 40 years, that's $144,000 of your own money invested. Now here's where it gets interesting. With an average 8% annual return, which is historically conservative for a diversified stock portfolio, that $144,000 becomes over $1 million. Let me repeat that. You contribute $144,000. You end up with over $1 million. Where does the extra $856,000 come from? Compound interest, the eighth wonder of the world. Before you think, I'll just save that money instead, let me show you why saving alone is a losing strategy. If you put $300 per month into a savings account earning 1% interest, you'd have about $177,000 after 40 years. Sounds decent, right? Wrong. After accounting for 3% average inflation, that $177,000 has the purchasing power of only about $54,000 in today's dollars. Meanwhile, the invested portfolio worth $1 million maintains significantly more purchasing power because stocks generally grow faster than inflation. This is why saving alone is not a wealth plan. Investing is how money actually grows. Compound interest is the process of earning returns on your returns. It's exponential growth, not linear growth. Here's a concrete example. In year one, you invest $3,600 and earn 8%, giving you $3,888. That's $288 in growth. In year two, you add another $3,600, bringing your total to $7,488. But now you earn 8% on the full amount, not just your new contribution. You gain $599. Year three, you earn 8% on $11,087. That's $887 in growth. Notice the pattern? Each year, your money works harder because the base keeps growing. Let's look at the full journey of $300 per month at 8% returns. After 10 years, $55,000. You contributed $36,000. After 20 years, $178,000. You contributed $72,000. After 30 years, $447,000. You contributed $108,000. After 40 years, $1,050,000. You contributed $144,000. Notice something critical. In the first 10 years, you contribute $36,000 and gain $19,000. That's about 53% growth. But in years 30 to 40, you contribute $36,000 and gain $603,000. That's 1,675% growth on your contributions during that decade. This is why the last years are so explosive. Your money has had time to compound on itself repeatedly. Let me show you why starting early is the single most important decision you'll make. Scenario A, the early starter. Sarah starts investing $300 per month at age 25. She invests for just 10 years, then stops completely. Total contributed, $36,000. Value at age 65, $620,000. Scenario B, the late starter. Mike starts investing $300 per month at age 35. He invests for 30 years straight until 65. Total contributed, $108,000, 3 times more than Sarah. Value at age 65, $447,000. Sarah contributed $72,000 less than Mike, stopped 30 years earlier, yet ended up with $173,000 more. This is the power of time. Those early years matter more than anything else. Now that you understand the math, let's talk about where to actually put your $300 per month. The answer for 95% of beginners: broad market index funds. An index fund is a collection of stocks that tracks a market index. The most famous is the S&P 500, which includes the 500 largest U.S. companies. When you buy one share of an S&P 500 index fund, you instantly own tiny pieces of Apple, Microsoft, Amazon, Google, and Tesla, and 495 other major companies. Here are the 5 reasons index funds beat everything else. Number 1, instant diversification. Instead of betting on individual companies, you're betting on the entire economy. If one company fails, it barely affects you. If the economy grows, you profit. Number 2, lower risk than individual stocks. Individual stocks can go to zero. Remember Enron, Lehman Brothers, Blockbuster? Index funds can't go to zero unless every major company fails, which would mean society itself has collapsed. Number 3, historically reliable returns. The S&P 500 has returned about 10% annually over the past 50 years. Some years it's up 30%, some years it's down 20%, but zoom out and the trend is clear: consistent long-term growth. Number 4, minimal effort required. You don't need to research companies, read earnings reports, or track news. You simply buy the index and hold it. That's it. Number 5, low fees. Index funds typically charge 0.03 to 0.20% in fees, which means for every $10,000 invested, you pay $3 to $20 per year. Compare that to actively managed funds charging 1 to 2%, and the savings compound dramatically over decades. You don't have to take my word for it. Warren Buffett, one of the greatest investors in history, made a famous bet in 2008. He bet $1 million that a simple S&P 500 index fund would beat a collection of hedge funds, professionally managed funds that charge high fees, over 10 years. The result? The index fund won decisively. It returned 125.8%, while the hedge funds averaged just 36%. Buffett's advice? For the average investor, just buy the index and hold it. Here's a beginner-friendly portfolio that balances growth with stability. 70% U.S. Total Stock Market Index Fund. This is your growth engine. It includes thousands of U.S. companies, from large to small. Examples: Vanguard Total Stock Market, Fidelity Total Market. 20% International Stock Index Fund. This gives you global diversification. You're not just betting on the U.S. economy, you're betting on global economic growth. Examples: Vanguard Total International, Fidelity International. 10% Bond Index Fund. Bonds provide stability and reduce volatility. When stocks crash, bonds typically hold steady or even rise. This is your shock absorber. Examples: Vanguard Total Bond, Fidelity U.S. Bond. This 70-20-10 allocation gives you aggressive growth potential with enough stability to sleep at night. Now let's talk about the strategy that removes all emotion, stress, and guesswork from investing: dollar cost averaging. Dollar cost averaging means investing a fixed amount of money at regular intervals regardless of what the market is doing. Every month, you invest $300. Whether the market is up, down, or sideways, you invest $300. No exceptions, no timing, no thinking. Here's how it works in practice. Month 1, stock price is $50. Your $300 buys 6 shares. Month 2, market drops. Stock price is $40. Your $300 buys 7.5 shares. Month 3, market rises. Stock price is $60. Your $300 buys 5 shares. Total, you invested $900 and own 18.5 shares. Your average cost per share is $48.65, better than if you'd bought all at once at $50. Notice what happened. When prices were low, you automatically bought more shares. When prices were high, you automatically bought fewer. You averaged out the volatility without making any decisions. Here's how to implement this. Step 1, choose your investment day. Pick a consistent day each month. I recommend the day after you get paid. This way, the money leaves your account before you can spend it. Step 2, set up automatic transfers. Most brokerages allow automatic investments. You link your bank account, set the amount, $300, and choose the frequency, monthly. Step 3, select your index funds. Allocate your $210 to U.S. stocks, $60 to international, $30 to bonds. The system automatically buys the right amounts each month. Step 4, forget about it. This is the most important step. Once it's automated, don't check it constantly. Don't try to improve the system. Just let it run. The whole setup takes about 30 minutes. Then you're done. It runs in the background for decades. Let's talk about the mistakes that destroy wealth. These are the reasons why 90% of people never become millionaires, even when they have the knowledge. Mistake number 1, trying to time the market. This is the belief that you can predict when stocks are cheap and when they're expensive. Studies show that even professionals can't do this consistently. Mistake number 2, panic selling during crashes. Market crashes are not the problem. Selling during crashes is the problem. Every major crash in history has been followed by recovery and new highs. Mistake number 3, following social media hype. By the time everyone on social media is talking about a stock, you're already too late. You're buying at the peak from people who are selling it to you. Mistake number 4, switching strategies constantly. Consistency beats perfection. Sticking with an 8 out of 10 strategy for 40 years beats switching between 10 out of 10 strategies every year. Mistake number 5, investing money you need soon. Only invest money you won't need for at least 5 to 10 years. Short-term money belongs in savings, not investments. Mistake number 6, checking your portfolio daily. The more you check, the more likely you are to make emotional decisions. Check quarterly at most. Mistake number 7, giving up after year 1. The first years feel slow. Remember, the biggest growth happens in the final years. Most people quit right before the exponential phase. You now have the knowledge. Let's turn it into action. Here's your step-by-step plan. Week 1, foundation check. Review high-interest debts, calculate emergency fund needs, confirm stable income. Week 2, choose your platform. Research brokerages, Vanguard, Fidelity, Schwab. Open account, link bank account. Week 3, set up automation. Choose investment date, configure automatic transfers, select index funds. Week 4, make first investment. Execute first purchase. Verify automation is working. Set calendar reminder to check quarterly. Here's what I want you to remember from these 30 minutes. Becoming a millionaire isn't about luck. It's about math, it's about consistency, it's about time. You don't need to earn 6 figures. You don't need to be a genius. You don't need perfect timing. You need $300 per month, a simple strategy, and decades of patience. Most people will watch this video, feel inspired, and do nothing. That's the sad truth. They'll go back to their old habits, they'll keep spending everything they earn, they'll keep making excuses. But you're not most people. You made it through 30 minutes of education. You have the blueprint. Now you just need to execute. Start this week. Not next month, not next year, this week. Even if you can only start with $50 per month, start. You can increase it later, because the most expensive mistake you can make is waiting. If you found value in this masterclass, subscribe to Smart Money and Finance Guide. Every week, we break down complex financial topics into simple, actionable strategies. Leave a comment and tell me, what's your biggest takeaway? What's your target monthly investment amount? I read every single comment. I'm Finn, and I'll see you in the next video where we dive even deeper into building wealth the smart way. Because small investments today create financial freedom tomorrow.